Hey friend, welcome back to the channel. This is Jeremy. I am a designer and co-founder of Yoder, which is a dividend tracking portfolio app. And I thought it would be good, since I built this tool about dividends and my whole investing style revolves around dividends, to take a step back and talk about why I believe dividend investing is the long-term strategy that wins every time. Now, I know this could be controversial. There's a lot of people who, have other styles that they like and other philosophies, and I think that's fine. I think that when you invest, you have to figure out what works for you and stick to it. I think the important thing is to stick to it, because that's what's going to help your money compound no matter what style or philosophy you take. So dividend investing, though, is the way that I can be consistent. It works for my personality. And so I'm going to give you 3 reasons. These aren't necessarily arguments to try to convince you to dividend invest. This is just why I believe in it and why I put my own money for my family at work in dividend investing. So there's 3 things. And before I get going, I want to point out that I'm just a guy on the internet. I'm a designer by trade. This isn't financial advice at all, actually. This is just me sharing my journey and sharing my thoughts. So do your own due diligence. This is just for entertainment's sake. So let's dive in. Number 1, why dividend investing? So the first thing is the end goal. Where dividend investing gets you in the end. It's that whole, the turtle wins the race, slow and steady wins, right? And when we think about this, it's good to compare dividend investing and the outcomes versus traditional investing. Now, let's look on the right here. Traditional investing usually relies on what is known as the 4% rule. And this is when you build up your portfolio over time, and then when you're ready to actually retire, you start to withdraw 4% of that portfolio. So you take 4% of it every year. So you sell stocks and live off of it. Now, this works for a lot of people. And obviously, the more you have built up, the higher you can pull, the longer it'll last. But the one catch here is that eventually the money could run out. Like, it is possible that you withdraw so much you outlive how much you have built up. The second thing is what's known as a sequence of returned risk. So this is when, at the point that you decide you're going to start to withdraw that money and hit retirement, what happens if the market suddenly has a downturn and it loses 20, 30% in that first year? Well, now your whole strategy, all your math is kind of thrown out the window, because you were forced to sell shares while they were lower in value. So you automatically are kind of changing the numbers right at the beginning. So that is something that could add to that uncertainty and that anxiety about retirement. Now, if we contrast that to dividend investing is really about the cash flow. So instead of saying, I'm going to withdraw 4%, you have this mindset that at the end, when you're ready to retire, maybe even retire early, you could have 4% in dividend yield that you're going to live off. So this is the passive income from your portfolio. When you start to live off those dividends, you don't actually touch the portfolio. It still continues to slowly build over time. Now, while you're doing this, you're going to reinvest those dividends as you're accumulating. So that's going to help you compound faster, which is another great benefit. But when you're ready, instead of reinvesting, you just start living off of it. And the great thing about this is you drastically reduce the risk of that sequence of return. And I want to show you this by looking at Yoder. We can check out TJ Maxx or TJX here. And if we go down and we look at these dividends and they're paid out, if you were a traditional 4% rule, then you would have sold your stocks in 2020 when the pandemic hit, which is obviously a very unfortunate and scary event. You would have lost a lot of money. But with a company like TJX, you would have just lost for a period of time. Your payout that year, your dividend payout, would have been reduced. But then the next year in 21, it resumed and picked up right where it left off. So you didn't have much risk. You suffered just that 1 year, and then you were able to rebound quickly. So my point here in all this is that dividend investing pays you consistently, while traditional investing is a hope that the money will outlive you. The last thing I'll say is that at the end of your life, with dividend investing, you are leaving a financial portfolio tons of value to your family, to your charity. So this is a legacy that's going to outlive you. So I really love that. As someone who has 3 kids, I think about that a lot. Okay, the next piece, you might have heard of The Psychology of Money by Morgan Housel. It's one of my favorite books. So start thinking about dividend psychology. So what about dividends specifically helps set me up to have a better mindset and potentially better results because I'm able to be consistent? And I kind of broken this into 3 things. So emotional reduction. I think that's a thing. Basically, I can sleep well at night because I'm lightening my emotional load that traditional investing may have because I'm focused less on the daily market moves and where my stock number, my portfolio number is, and I focus more on the dividends that's coming in, which is usually more steady. So in other words, if you look at Yoder here in our dashboard, I'm honestly focused less about, this daily movement, the 1 month, 6 months, the 5 years. I'm not focused as much on these types of metrics because in the end, that could change drastically. But the dividends, if it's a solid company with steady growth over time and a history of that prioritizes their shareholders, then I can focus on the dividends tab. And this is going to show my money growing over time. And right now, as I'm building, you can see I'm $200 coming in average a month, and I have a good ways to go. But at the end of this portfolio, all of these expenses will be covered and paid for. And that's when I'm financially free. And if I retire at that point, I don't really care what the market does because this money's coming in. Unless it's a drastic event, I'm okay. And I don't have to have that anxiety that I would otherwise have. And I can just focus on these companies continuing to pay me month after month. And I can look here at this portfolio and see the dividend growth. So these companies are growing. And, over time, that is what is going to build my confidence and help me sleep well at night. So the next thing is it's really that long-term perspective here. So I'm able to shift away from even caring what they're talking about on CNBC, even though it's great for entertainment. I can step away from that and I can just let my dividends reinvest and let them earn me money over time. It's passive income that is working for you while you sleep. The foundation of this, the philosophy, is what I apply to my life in general, which is small, consistent actions create powerful results. I laugh at this, thinking about this, because if you look at my newsletter, it's called A Walk to Wealth on Substack. And I came up with this because when my wife and I moved into our house, it's 2019, we bought the house, and the pandemic hit and we had a lot of time on our hands, so we started walking. And I will never forget the first time we went walking. We walked out on our street, went up the hill to the stop sign, and I asked her, I said, "Which way do you want to go?" And she said, wait, I thought we were just coming here and going back. And that's because we hadn't walked that much. We walked up that hill and, she was ready to walk back and call it a day. But over time, we kept going. And within a few months, we were out there walking 2, 3, 4 miles a couple times a day. So it was a small, consistent actions that ended up creating powerful results. And that is basically the philosophy behind dividend investing, especially dividend growth investing. All right, number 3 is automatic discipline. Simple decisions. You're not worried about trying to time the market and buy the stock at the right time or put your money. You can just put it in consistently, set up a dollar cost averaging strategy where every time you get a paycheck, you put a little bit of percentage of that into buying more stocks. It helps you stay consistent. It helps you not to get in your head. And ultimately, it helps your money to compound over time, because usually what we do is we worry, we stress, we sell something, and we break that compounding. So those are the psychological reasons why dividend investing pays off. I think this is something that's highly, undervalued, but can really make a difference long term, not only in your finances, but your life. Now, the next thing, the final piece, the third piece here, and this is the biggest argument that people have, and that is that when you invest in dividend stocks, you are not going to have the growth in your portfolio, so your portfolio is going to always lag behind. And I didn't create a graphic with this. I wanted to show you the actual numbers because I don't know that you would believe me unless I show you this. So I want to walk through a few scenarios here. And I want to compare over time the S&P 500, which is generally considered the market, versus Schwab's most popular dividend ETF, and also Vanguard's most popular, which is the dividend appreciation ETF they have, VIG. So I want us to look at this over time. And this is total return. So this does include dividends being reinvested. So keep that in mind. But in year one, so just 1 year from today, if we look back, SCHD has actually outperformed the S&P 500 by, a good percentage. You see 26%, S&P is at 20, VIG is at 18. So, VIG's been falling pretty close, but SCHD over the last year has actually beat in total return the market. If we look at 3 years, S&P 500 is up to almost 70%, while SCHD is at 50. So I'll give you to you on that one. And for the last 3 year period, the S&P 500 has kicked SCHD's tail. And VIG, it's kicked VIG's tail too, because VIG is almost at 56. And then when you go to 5 years, it's still ahead a little bit. So S&P 500 is still winning. It has about 72%. SCHD is about 52. So not much change there in that 3 year and 5 year. But VIG has performed well. VIG is focused strictly on dividend growth, and they're at 66. So not far behind S&P 500. Now, when we look at the 10 year, I really think we're getting pretty close. We're starting to split hairs. The S&P 500 still wins. It has a 250% increase. We can see here with the blue line on the graph. SCHD has 223% with the orange line. And then if we look at VIG, the purple line, we have it at almost 240%. So the S&P won, but not by a whole lot. Now, this is what most people don't look at, and that is I did a custom time frame here. I went back to, I believe it was January 1st, 2011. That's around when SHD hit the scene. So that's about as far back as we can go to compare these. So this is a 15-year comparison. Now, this is what I want you to see, because you probably wouldn't believe it unless you saw the numbers and saw this chart here. So if we look, the S&P 500 in the last 15 years has a total return gain of 490%. SCHD has a total return of 500%. So SCHD actually over 15 years has beat out the S&P 500. And then VIG has slightly beat them all with 508% gain. So I would still say this is splitting hairs, and I'm okay with that. I don't need SCHD to beat the market, over this time period, even though it did. But I just want to show you that if you invest in high quality dividend stocks, dividend growth stocks, you can build a very strong portfolio that doesn't have a bunch of hype, that doesn't have the worry, that you don't have to think about timing. You can just invest in it consistently over time. And that's why I have started to build out in the last couple of videos a new portfolio that we just started. We just invested $1,000, but this is so we can actually track this and see how this works over time. So this is a 12 stock portfolio that I used the Yielder high quality score to find the best dividend stocks that I believe in for the long term. And you can see them here. You can go back and watch those videos. I'll try to link to those so you can check it out. These are companies that I think are exciting. They're not boring like some people say. I think following real estate trends of Trino Realty Group is an exciting thing to do, and to know that when you own a company like this, you actually are a real estate owner. You own the properties that the company owns because you're a part owner by just owning stock. I think Visa's fascinating to watch. Definitely Microsoft as a tech company, Accenture, all these companies to me are exciting ones to follow. And so we've created this. Follow along with me. Over time, I want us to grow together. Again, dividend investing may not be for you. That's fine. If you do love dividend investing, put in the comments, let us know why. What's your favorite reason that you invest in dividends? Why is it important to you? If you have another strategy that you like, hey, tell us about it. We love to learn. We want to be open-minded about investing. I think that's one of the worst things you can do, is to think that your strategy is the only right strategy. You want to be able to hear from other voices, understand, why they invest the way they do. And we're all learning, and we're all doing this together. So I hope you learned something. Let me know in the comments. And until next time, happy investing.